Welcome to World Insight. Please subscribe and hit the bell icon for more breaking updates. Global banks are at a pivotal moment, standing at the intersection of tradition and transformation. They are now forced to choose between the enduring dominance of the US dollar, which has been the backbone of international finance for decades, and the rapidly rising influence of China's oil market, which is reshaping the global energy landscape and challenging established norms. The US dollar has long anchored international trade, providing stability and predictability for businesses and governments worldwide. But China's economic ascent, fueled by its massive energy needs and growing global partnerships, is shifting the balance, especially in the critical energy sector. Aggressive US trade policies, particularly under President Trump, have disrupted traditional flows and forced banks to reconsider their strategies. These policies have introduced new uncertainties, prompting financial institutions to rethink their global positioning. Tariffs meant to protect American industries have inadvertently driven global players to seek alternatives, including deeper engagement with China. As a result, trade routes are shifting, and new alliances are being formed in boardrooms and trading floors around the world. As China expands its oil market and pushes the yuan onto the international stage, banks must weigh the historical stability of the dollar against the promise of new opportunities in China. The yuan's growing acceptance in global transactions is forcing a re-evaluation of risk and reward. This isn't just a financial decision. It's a high-stakes calculation involving currency stability, geopolitical risk, and access to emerging markets. The choices banks make now will have ripple effects across industries and continents. The outcome will shape not only bank profits but also the future of global economic alliances, influencing how countries cooperate and compete for decades to come. Banks know their choices now could redefine the world's financial power structure, determining which currencies and markets will lead the next era of globalization. The crossroads is clear: stick with the familiar or embrace the new. The decision will echo far beyond the walls of any single bank, shaping the very foundation of the global economy. Trump's tariffs marked a dramatic shift in U.S. trade policy, signaling a new era of economic nationalism and protectionism. For decades, the United States had championed free trade, but this approach upended long-standing agreements and relationships with key trading partners. The tariffs targeted a wide range of imports, from raw materials like steel and aluminum to finished products such as automobiles and electronics. The goal was clear: protect American industries, revive domestic manufacturing, and shrink the persistent trade deficit that had long concerned policymakers. While some sectors like steel and textiles benefited from less foreign competition and a temporary boost in demand, others, especially those reliant on imported parts or materials, faced higher costs as imported goods became significantly pricier. Retaliatory tariffs from other countries quickly followed, sparking global trade disputes and escalating tensions with major economies like China and the European Union. These moves exposed the deep interconnections of modern economies, where supply chains stretch across continents and industries depend on global cooperation. The risks of unilateral action became clear as businesses scrambled to adapt and uncertainty rippled through markets. Tariffs also fueled inflation, as importers passed costs to consumers, making everyday essentials and household goods more expensive. Shoppers felt the pinch at the checkout, with rising prices on food, electronics, and clothing affecting families nationwide. This price surge hit household budgets hard, forcing many to cut back on spending or search for bargains. The economic strain stirred voter frustration, fueling debates and protests, and ultimately influencing the broader political climate. Intended to strengthen the U.S. economy, the tariffs instead triggered complex, far-reaching consequences that rippled through industries and financial markets. The ripple effects extended well beyond America's borders, reshaping global trade and leaving a lasting impact on economies worldwide. Tariffs reshaped U.S. trade dynamics almost overnight, sending ripples through every sector connected to international commerce. The sudden policy changes left businesses scrambling to adjust, as the cost of doing business with foreign partners shifted dramatically. The trade deficit dropped by nearly 24% in August 2025, mainly due to a 5% fall in imports as companies adapted to new costs. This marked one of the most significant monthly changes in recent history, highlighting just how sensitive the U.S. economy is to shifts in trade policy. An initial import surge, businesses racing to beat tariffs, was followed by a sharp decline. Companies rushed to stockpile goods before the new tariffs took effect, but soon after, Import volumes plummeted as higher prices took their toll. Exports rose slightly, but not enough to offset the year's overall deficit, which remained high. American goods became less competitive abroad, and global demand was not enough to close the gap. More expensive imported materials hurt U.S. exporters, eroding their global competitiveness. Many manufacturers faced tough choices, from raising prices to cutting production, as they struggled to absorb the increased costs. Many struggled to maintain market share as costs climbed. Some businesses were forced to lay off workers or delay investments, while others sought new suppliers in an effort to stay afloat. These shifts disrupted global supply chains, forcing countries to rethink trade relationships and logistics. The ripple effects were felt worldwide, as companies and governments scrambled to adapt to the new reality. Some nations pivoted toward China, seeking new partnerships and trade routes. As the U.S. adjusted its policies, other countries looked for stability and opportunity elsewhere, accelerating the shift in global alliances. The U.S. adjustments sent shockwaves through the global economy. Stock markets reacted, investors grew cautious, and economists debated the long-term consequences of these dramatic changes. Trade patterns realigned, and economic strategies worldwide had to adapt. Governments and corporations alike began to rethink their approaches, seeking resilience in an increasingly unpredictable environment. The world's supply chains will never be the same. The events of 2022, the one tendency of the Sowai, Benzerbawi Dister, Wine Som An, Bomgardensi or Verizurniko Bawi buying Sterny Point, ushering in a new era of uncertainty and transformation for global trade. The banking sector faces a strategic dilemma: stick with the US dollar or pivot to China's oil-driven opportunities. The dollar's historic dominance offers stability, but recent US trade policies have shaken confidence. China's push to make the yuan a global currency, backed by its growing oil market, is tempting banks to diversify. Engaging with China opens vast new markets, but also brings geopolitical risks and regulatory uncertainty. The US-China relationship is fraught, and banks must tread carefully to avoid overexposure to either side. Every move is a balancing act between stability and growth. The stakes are high. The wrong choice could mean lost profits or political backlash. Banks' decisions now will shape their future in a rapidly changing world. Trump's tariffs have driven up inflation and consumer prices across the U.S. Higher import costs are passed to consumers, raising the price of everything from electronics to cars. Households are feeling the squeeze, adjusting budgets and cutting back on spending. Inflation remains stubbornly above target, complicating the Federal Reserve's job. Policymakers debate solutions, cutting tariffs on essentials or seeking new trade deals. But each option has trade-offs. Domestic industries and international relations hang in the balance. The debate over how to manage inflation and protect consumers is far from settled. The cost of living crisis is now a central issue in American economic policy. To counter voter anger over rising prices, President Trump proposed $2,000 rebate checks funded by tariff revenue. The plan, announced in December 2025, aims to offer relief and boost spending. Critics say it's fiscally unsustainable. The checks would cost $600 billion, but tariffs only bring in $300 billion a year. The proposal risks ballooning the national debt and faces an uphill battle in Congress. While the checks might offer short-term relief, they don't address the root causes of inflation or trade imbalances. The debate highlights the limits of using tariffs as economic policy tools. The future of the plan remains uncertain amid political divisions. Trump's tariffs, imposed under national security grounds, have sparked fierce legal debate. Critics argue the president overstepped, bypassing Congress and upsetting the balance of power. In November 2025, the Supreme Court took up the case, questioning the president's emergency powers. A ruling could set a precedent, limiting executive authority and trade policy. The case comes as Democrats gain ground in Congress, intensifying scrutiny of Trump's trade moves. The outcome will shape the future of U.S. trade, governance, and executive power. All eyes are on the court as the nation awaits a decision. Trump's global tariffs have transformed both the U.S. and world economies. Banks face tough choices between the dollar and China's oil, while trade patterns and inflation shift at home. Domestically, higher prices and controversial rebate proposals dominate debate. Internationally, trade relationships are being redrawn, and banks are rethinking strategies. Legal battles over presidential authority add another layer of complexity. The lessons from this era will shape future trade and economic policy. The world is learning. In a connected economy, every decision echoes far and wide.